Good afternoon, everybody. It's Andy O'Fee, the Yankee Closer, and happy Friday. I hope you're all getting ready and decked out in your green for St. Patrick's Day weekend, and it has been a very interesting week in the fixed income and in the stock market as well. We saw yields get pushed down again today through a very, very significant support level, which is really in turn relating to better interest rates, rates we haven't seen in almost a year, which is great for us. But the real test is really, what does this mean? What's going to happen as we go forward into next week? I think traders now are in a position where they're looking at the FOMC meeting next week and the verbiage that's going to come out of that. I do not anticipate them raising short-term rates at all, given the fact we've seen incredible job growth as well as a rebound in the stock market. So I think their hands are tied as far as that goes. But things I've been mentioning since the beginning of the year have been balance sheet reduction. And I think the terminology that they're going to use coming out of that, whether they are not going to reduce the amount, which right now is at 50 billion, and I really think that that comes out and they say, well, we're going to reduce that, then the market could be off to the races, and that again would be beneficial to us. So we're sitting right now at a very, very interesting point in yields on the 10-year note after pushing down again slightly lower. I was encouraging people to go ahead and take advantage of this as a lock opportunity. We may have seen a slight improvement in rates through today, but not much where I would really be fearful about missing the bottom per se. What's happening really, if you want to think about it, is that there are positions in the street where there are street positions that are short. There are other positions in traders who are not carrying any position at all. And what they're doing is they're squeezing the shorts, causing them to go into something called a pain trade. And all that's doing is it's a relief rally. They're causing them to go in and buy securities to cover their shorts and basically push yields lower. So again, when we see that pain trade, it's not very self-evident. There really hasn't been any telltale signs as far as investor data or economic data that's come out that has really pushed rates down. If we saw a weaker number on the economic side, or if we saw a weak stock market, heck, we just saw the S&P rally again. The Dow Jones was up again today. So there's really no correlation that you would always see traditionally between stocks and bonds. This is really the bond market reacting to what I think is going to happen next week with the Fed in regards to them taking more of a dovish stance with their balance sheet. But it's all wait and see. So let's take a look at the chart to show you where we stand on a one-year basis on yields in the 10-year note. Let's take a look at that right now. So as you can see, we're back down here to 259. We're touching that level right now. We got back here towards the beginning of the year where again we saw rates, but again we haven't seen this type of move in quite some time. So that's why I'm being a little bit more defensive with people saying go ahead and take advantage of the rate lock right now. Now, if your position is, hey, I think, Andy, the market's going to rally more and rates could drop lower, we do have a program, and this is a free option for you. It's called Lock and Float. You float your rate down. You lock your rate in today at, say, 4.25. The market rallies in the next 2 weeks. You're closing in 30 days. The rate goes to 4%. Boom, you can reset your rate. One caveat, you pay 0.25% up front as a hedge cost to me that will be taken out of your closing costs as part of it. And if you decide to reset the rate, if the rate does not move, it goes higher, your rate stays the same at 4.25. The quarter point that you pay me up front goes back to you as a credit. It's a free option. You don't have to exercise it if the rates improve. If you don't think the quarter point is worth it to lower your rate by 1/8 of a point, it is your option. I encourage you at this time in the game with the market so volatile, everyone is so rate driven right now. Now that we're moving back off of 5%, we're almost below 4.5. Everyone is out there stumbling over their feet to get the best rate possible. Lock it in today, pay the 1/4 of a point, and use the free option to go ahead and hedge yourself. It makes perfect sense. If you have more questions, please give me a call. 2.59 on the 10-year note. FOMC big meeting next week. Hey, let's see if those short positions get squeezed some more and we can squeeze a little bit more yield out of the 10-year note. Andy O'Fee, happy St. Patrick's Day. We'll be back on Sunday with a very special edition of Tips from Tate on St. Patrick's Day. Have a good day. Bye-bye.